Hi everyone, my name is Dawn Brolin. I'm a certified public accountant, certified fraud examiner, the president of Powerful Accounting Inc., and the author of the Designated Motivator for Accounting Professionals. I'm here today to talk to you about Canopy. Canopy is an awesome tool if you are doing tax returns or tax representation, either way. What it allows you to do is pull transcripts from the IRS. They have an integration certified by the IRS to pull transcripts. What I love about it is I log in one time. I connect my e-services account and I can go into Canopy and pull transcripts. I don't have to continue to log into the e-services, put in my password, get my code, and get in and finally just get through e-services. It's so cumbersome. So I use Canopy. It's that one-time connection. Let me give you a couple tips. Number one, I like to pull transcripts for some of my clients who make estimated tax payments. Maybe they don't provide me a copy of the estimated tax payment. I want to make sure I know the correct dates of those estimated payments, okay? So I will go into Canopy, pull an account transcript for my client, and be able to see what dates they made their estimated payments. Just solves for a lot of problems. There's no notices. Maybe I thought they did $4,000 or $5,000 estimated payments when really they only did 3. They told me they did 4, they only did 3. A notice comes in because they didn't pay enough in tax, and now they're saying you did the tax return wrong. That happens all the time. So to eliminate that pain of that process and that, customer integration or customer experience, right? We want to eliminate notices at all costs. So that's one really key thing. The second one is when you're not sure if the client's given you all of their documents. Maybe there's a 1099-R that they had from the year before, and for whatever reason they don't think they can find it. I can pull a wage and income transcript, pull down all that information. So at least I have the federal information on that 1099 if it's applicable, if they received one for that year. And it eliminates, again, the whole concept of notices. So I find it really important as I'm preparing tax returns to have this tool in place. And so I love using it. So as a tax preparer, those are a couple of tips how you can use Canopy in your practice. Thanks for listening. Well, hello, everybody, and welcome back to another episode of the DM Disruption with myself, Dawn Brolin, and I am joined by a new best friend, Paul Hamann with RC Reports. And this episode I'm so excited about. Paul, say hello. Tell us a little bit about yourself.
Thank you, Don. As Don mentioned, my name is Paul Hamann. I'm a founder of a company called RC Reports, and our software determines reasonable compensation for closely held business owners.
Very exciting. And it's something that I think, at least for myself as a practitioner, I haven't really put it in the forefront of my mind. I feel like there's so many other balls I have to keep in the air. This is one I would have dropped. And thankfully, I found Abby again. And so Abby Deaver, that is an amazing marketing human being who is with you guys. And I've worked with her for years with SmartVault. And so when she ever reached out, I was like, whoa, what do you mean? What is this reasonable comp? Now I've seen it, you look on Facebook and you see it, or you look on various avenues, but you're like, oh, reasonable comp. Yeah, I don't have time for that. And then when you realize the implications, you go, oh no, I better learn about this. So tell us about the evolution of RC Reports. Obviously, we know major compliance issue that people really may not be paying attention to.
Yeah, absolutely. So you were spot on when you said, it's out there, but people don't really necessarily understand how many parts of their business it touches. And it touches all the way from the very beginning, should I even be an S Corp, to, hey, I am selling my business. I need to normalize my comp before this business goes on the market. And all places in between: retirement planning, family planning. Sometimes it comes up in divorces, different places. So it is sprinkled out throughout the lifespan of a company. But I ended up in this space because I was in compensation prior to getting into, even more specifically, into reasonable compensation most of my career. But it was in the late 2000s that I was pulled directly into reasonable comp because there was a spike in compliance. And so practitioners had reached out to me saying, hey, Paul, my client's getting audited and we have no idea how to come up with this number.
Right.
And so I got pulled into that space, and I got to tell you, I was looking for us. Seriously, I'm like, I need to find us out there because I need to figure this out quickly and affordably. And there wasn't anybody doing it. So I was doing these one-off studies that took me about 2 days to do. They were $2,000 to $3,000 a piece. I don't think your clients would be all that excited to pay $2,500 for for a report.
Right.
And I got to tell you, I was nervous about defending them because some of the data wasn't that great.
Mm.
Quick fast forward through through a couple of years, but I got together with some folks that are way smarter than I am.
That's always a good idea, by the way.
Oh my gosh, and it's so easy to find too. Um, in programming, in statistics, and wages, and we sat down and we started brainstorming, and what we came up with is RC reports, and we launched in 2012. So we're 10 years now. This is our big decade anniversary.
That's awesome. Congratulations. That's, there's always any of those milestones are always awesome. Like, hey, I've been in business now for 10 years. And I think that it's interesting how a lot of times how people develop either a new software or they develop some new platform or whatever, it's around a pain point they had that they're like, oh, so there no one else is solving for this. Let's figure it out. And it's easy to go on Google. We call it the Google. You go on the
Yeah.
Google and you're like, I need reasonable compensation for blah, blah, blah. And it's like, no, that's not gonna fly. And that's something that I have done that before. I'm Googling reasonable comp or whatever. And I'm like, I just need something. And then I'm like, oh, shiny coin or something. Okay, I'm going over here now. I'm gonna go do something. Forget that. I'm gonna go move on to this over here because that looks like it's too complicated and I don't have a resource. So RC Reports is doing that. So tell us about, because obviously reasonable comp for the closely held, the S Corps, the C Corps, things like that. And that's really important. We could talk a little bit more in depth, but there's a couple of other tools. And you mentioned one about the valuation and normalizing the payroll. There's also a quick report. So let's talk a little bit more about a couple of those other pieces.
Sure. So reasonable compensation for most closely held business owners revolves around compliance, and that's going to be S corps. But there are other reasons you may want to run it, such as your C corps, or if you need to normalize it for valuation. But taking that number and then also figuring out how it applies to your company, we have some different tools around that as well. And one is our entity planner. I think that's where you're headed.
Yes. Yep. Exactly.
So business owners are great about networking with one another and then hearing that, hey, I should become an S corp because you're absolutely going to save money on taxes.
Right.
Well, absolutely is one of those words I tend to stray away from. You may see, probably, maybe, let's take a look and see. It depends. And that's where they need to contact Dawn. Right. They need to talk to you and say, hey, Dawn, I'm either starting a business or I've been in business for a while. I've heard I can save money if I become a S corp. Is that true?
Right.
Easy enough to do, but you do need to know what your reasonable comp is because that is one of the key components that plays into that piece.
Right.
And so we do have a tool, our entity planning tool, that you can plug that number into along with some other pieces of information. And it'll produce a nice one-page layout you can hand to your client that says, hey, look, you know what? It's not quite time, at least from a payroll tax standpoint, right? There's other considerations, and we don't want to get into the legal ones today, but from a strictly dollar standpoint, it'll give you a very clear indication as to whether that makes sense.
So that tool for me has been very exciting. And the reason for that is they'll call and they'll say, and I had a call with somebody just a few weeks ago, and he was like, hey, so should I move to an S corp? And historically, my answer would have been, oh, well, we usually recommend that once you get to the $90,000 to $100,000 in profit, now we can, let's just say we paid you like 65 or 70,000, we can save you X number of dollars on self-employment tax, right? That's been the general answer we give people because we didn't have a tool. But now with a tool, having that conversation with him was very different. It was like, listen, it's not my opinion anymore necessarily. It's now I've got some factual data to show you where we're at with that process. And I think that having that tool gives us a better ability to, even if it's a not, hey, it's time for you to move to an S corp, even if you did that analysis and said, hey, but I think maybe next year, what are we looking at? What are our projections? And we're starting to have that conversation to say, remember, we have January till March 15th to make that election. We know what's happened so far this year. It wouldn't have made sense for 22 or 23, whatever. Now it's a conversation to say, hey, this is something we might want to think about. What do you think? Do we look at the first couple of months and then decide like last minute, like be prepared? So those are helping us with factual information to have these conversations, which is so different.
Yeah, absolutely. And having that conversation with an S corp and saying, or not a potential S corp, and saying, you know what, you're not quite there yet. We can certainly go that direction if you want, but it's not going to save you the taxes that you may have heard about or seen on
Right.
as you call it when you consult the Google.
The Google or your, I love this one. Hey, I talked to a friend and I'm like, punch your friend in the face for giving you bad advice. Like, how about, and it's so funny that you say that because this is one of the things I don't know how many times I've said this before, but so I tell my husband, he'll say to me, oh, the car's broken. I think it's going to cost $5,000. So we should just go buy a new car, which we know that's a ridiculous statement in and of itself.
Yeah,
And
but if you
so,
want a new car, it's not.
well, that's true. If you're fighting, if you're trying to negotiate for a new car, I get it. And I'm like, Kev, I didn't realize we've been married for 25 years. I didn't realize you owned a mechanic store. When do you work there? Because I've never seen you go to the shop. And he's like, what are you talking about? And I'm like, so you're telling me that you as the mechanic is assuming that it's going to be $5,000. How about you go down and get an estimate on paper and bring that back to me so we can actually have some facts to talk about? It's the same thing. It's no different. And so having those facts is so critical. And then obviously, and this is important that we talk about this. Let's talk about reasonable compensation and the consequences for ignoring it or not addressing it.
Yeah, so we're all familiar with examinations and audits. Reasonable comp can get challenged in a number of different ways. Traditionally, most people think of it through just your general S corp audit, where it comes up, and as part of the audit of the entire S corp, the examiner may say, hey, by the way, how did you come up with your reasonable comp figure, right? Or this looks high or low to me. We don't typically talk about high. It has come up more now that we have 199 Cafe, and
Right.
that's probably more detailed discussion than we want to have today, but we have seen it go both directions.
Okay.
We both know Eric Green real well.
Yes.
He's the Three Bears guy, right? Not too high, not too low, just right.
Yep.
So when those audits come, they can come traditionally. They can also come through the Employment Tax Compliance Program. If you're familiar with that, that's the did I pay my people correctly, 1099 or W-2?
Right.
They have a specialty work stream in there. If it's an S corp, they'll challenge it.
Okay.
So that's another way you could see that coming with that, or you may not see that coming, and all of a sudden it's like, wait, we were looking at, I paid myself W-2. Why are you looking at my salary?
Right.
Well, it's because within that they built a specialty work stream. And then last, they did put a new CIP in place last year, Compliance Initiative Project, just to go after reasonable comp and S corps. So it's heading. It can hit an S corp owner from those three different directions, and you just need to be prepared.
And so on top of that, thinking about obviously our small business owners, we want to protect them from any kind of compliance, penalties and all this stuff. But what I don't think people may know is that the practitioner is subject to penalties as well. Is that correct?
That is correct. So two places I've heard this happen now. So one is that specialty work stream that I just described. They were instructed if they make a change to reasonable comp to assess a paid preparer penalty. And they're right around $5,000. And we've talked to a couple of practitioners that have had that happen. But Eric Green just shared a situation he's working through currently where this happened to a practitioner who's been doing this. Don, please tell me if you haven't heard this, but I know you have. I've been doing this for 35 years. It's never been a problem. I've always done it this way, so it must be right. Well, it wasn't right. And he had a number of clients who weren't taking reasonable comp or enough reasonable comp. And he had one of his clients challenged, they recharacterized, they hit him with a $5,000 preparer penalty, and then they worked through his other S corps. And I want to say something like maybe 10 or 15 of them, but then they hit him for 2 years. So long story short, he ended up with a $5,000 preparer penalty on each of those clients twice.
Wow.
And so he ended up with $130,000 in paid preparer penalties that Eric's helping him with. So yeah, and plus he has a whole book of business that's mad at him right now.
Yeah, people are not happy because they've got penalized as well. So
oh, absolutely, and that's about 2.5 times the original tax that would be owed just from a payroll tax standpoint. So if you would have owed $10,000 in taxes, you're probably going to owe about $25,000 total by the time you pay your taxes, penalty, and interest.
That if that is not frightening enough for anyone who is listening, I don't know what is. You know, it's funny because you say a lot of times we as practitioners are like, and I definitely feel this way. Like I worked so hard for my 3 letters at the end of my name. I am not willing to do anything to jeopardize those. But sometimes we don't think of it even at a softer level. Like that's like you really have to do something bad to lose your letters. But even that point of the reputation that you have that this has happened is way bigger than $130,000, right? So now you've got reputation issues, you've got clients that are going away, lost revenue, and now acquiring new clients, hoping they didn't hear about what you didn't do, not what you did, what you didn't do. And I
Right.
think it's that fear of the unknown has to be. It's part of my soul. I was up at 5 o'clock this morning worrying about all kinds of stuff. You know,
Absolutely. Yeah.
I don't
Well,
know.
and as you said, the 3 letters at the end of your name. And so let's see if I sometimes I forget the exact name of the office. Is it OPR?
Yep.
So when you get that prepare penalty, guess where you get referred to?
Yeah.
And so there's that's happening too. Now you're distracted from I don't know how many different directions, including losing those 3 letters at the end of your
Right.
name. So it's a big deal. And uh, we have a saying around RC reports: the first with a fact-based figure wins. So if you are showing up with a number pulled out of thin air, which a lot of folks are, it makes it so much easier for the other side to say, no, this is what we think the number should be, and then the fight begins.
So now let me ask you this question. So obviously, like for me, this is a big part of November and December for my firm. We're doing reasonable comp analysis so we can make sure people are paid by the end of the year, bonuses if necessary, whatever it may be. So I'm just thinking as we're going through this process, are you seeing that people are starting to pay attention more? Are they starting to become more aware, you know, as far as like, because I think the problem is, and I think that's why this is really great that we're doing a podcast, we've got webinars, and we'll talk about where they can go for that. But we've got to get this into the forefront of the people who it is an unknown right now, and how can we get to them this information so quickly? And that's what RC Reports has been doing. You've been out there, you're educating, and I know you have like a 2-hour webinar that really digs into the details. So can you tell us a little bit more about that?
Yeah, so we do a lot of education. We're very education forward, but our core class is a 2-hour deep dive on reasonable compensation. And we start off with the basics, but we go into some very detailed areas. We also go into areas that give a lot of practitioners headaches and questions, and we help you resolve those questions and issues. We also go into the facts versus myths. There's so many myths about reasonable compensation. They've been out there for so long that a lot of practitioners, like the one Eric Green was working with, they've adopted those as facts. They believe them to be true.
Right.
And so finding out that they're not is a wake-up call. And this is the perfect time to talk to your client. I have a great friend who's a CPA. He says, I have this entire toolkit that I get to use up until December 31st to help you. And on January 1st, I have a screwdriver. So let's talk.
Exactly. And so when you're like, so your CPA friend, or even just me, as you're saying, okay, listen, like right now, I'm so pumped, I'm jazzed about this, and because I found another way to protect myself. That's the way I look at it. It's another way, one, that I can protect myself from doing things incorrectly, because you don't know what you don't know, which is the fear. But you also are helping protect your client, which is also super important. So I'm here, I'm doing my analysis, November and December, I'm working through my clients. When is the next time I should be doing another analysis? Because obviously wages change, inflation, deflation, whatever it may be. So what does RC Reports just recommend? Obviously, this is not legal advice, but
Absolutely.
disclaimer.
Yeah. So once a year is what is minimum, because
Yeah.
you throw that in your file. And if an audit comes your way, you're flipping from defense to offense, right?
Mm,
IRS is like, hey, we don't like that number, or how did you get that number? Here, this is how I did it,
yep.
right? And now the tables are turned, and the IRS is like, oh, do we really want to fight this, right? They actually know, they actually have an answer to this. Nobody usually does.
Right.
But this time of year is perfect. Reconcile the year. Did we pay enough? Did we overpay? We have some time to make those adjustments before year end, right?
Mhm.
Plus, it gives us a starting number for next year. So we get into next year, we know what we're going to be doing through the first 3 or 4 months. We all take our 2 weeks after April 15th. We get our sanity back. And then
Yep.
in May and June, we start doing our consulting. We're reaching out to our clients to see where they are. Sometime in that time frame, say, has anything significantly changed in what you do, how you're spending your time? Maybe you want to do it, make another adjustment there. Maybe everything's going fine. So at least once a year, but if something major changes and you want to make those adjustments in payroll, run another one, right? Run as many as you need to.
Yeah, and I love that because thinking about, you just put something in my head that I don't think I thought about before, was the fact that their roles may change. Like I never even like let that cross my mind till this moment, you know. Again, you don't know what you don't know, but I was more thinking of, okay, I need to make sure that W-2 is right at the end of the year. And I need to make sure when I'm doing a tax return, this is another little tip for people as you're planning for your next tax season, and you're just maybe hearing this, it's maybe you didn't have a chance to do this in 2022 and now you're already in 2023. It's not too late to start implementing this system in 2023, right? And so thinking about not just what the inflation, deflation, whatever the market is bearing for salaries at this point or whatever is determined, but rather what they're doing, which is so true because I just went through this with a client a couple of weeks ago. We sat down, we went through all the, what do you do? What do you do? This partner, that partner. So we got to figure out exactly what everyone's doing. And then what's that reasonable comp look like when 6 months from now, I have a guy who they own an oil company that they deliver oil and one that they do cooling and heating. Well, this partner has kind of been the one doing all the oil stuff, but also doing this. But what if he's now 100% oil? It's very different being an oil delivery guy and running an oil company than it is heating and cooling. So that is so interesting. It's like, okay, as their roles are changing and their job descriptions, if you will, are changing, responsibilities, that's a great time to then, hey, let's recalculate this. And it's not complicated. It's a matter of having that discussion. And I think that that is so important as we are moving to this advisory conversation. That's what this is. This is advisory and being able to say, and tax planning and kind of a little bit of everything, but being able to say to them, listen, this is something that we need to do regularly. As listen, if you start doing, you feel like you're doing things differently as your role in the business, we got to talk. But us being more proactive towards them, I think, is what's the important message here. We need to be the proactive professional that says, hey, this is important. We need to do it. Now, I don't know if the people who are listening what their clients do, but typically if Brolin is calling you and telling you need to do something, you better do it. Like it's like a parent-child relationship when you're in charge of that, right?
Oh, absolutely. And I think businesses, again, my opinion, humble opinion, businesses want that guidance.
Mm,
If Don says, hey, look, we need to look at reasonable comp, then we're going to look at reasonable comp. You wouldn't ask your client if they should look at reasonable comp any more than you would ask your client if you think they should do a tax return this year.
right.
That would just be a silly conversation to
Absolutely.
go to for sure. So
Yeah.
yeah, having those conversations and then using those conversations in and around your advisory role is a lot of fun
Yeah.
because you may look at the report and something might jump out in your mind, which is, hey, look, have you ever thought about moving over to a payroll service? Because look how much of your time is spent. But I'll tell you, the really fun ones are when the client's head just goes, wow, didn't realize how much time I was wasting over here where I could be
Yes.
making money over here. Let's
Absolutely.
figure that out together.
Yeah, that's super important. So let me ask you this question. Is another, I have so many questions for you, which I know we only have a certain amount of time on the podcast, but we're doing webinars and we're doing other things for education. But thinking along those lines of um, alerting them, if you will, of how much time they're spending on certain things. So you have an awesome tool called a client. It's like it's called Client Survey. Am I saying that right?
Yes.
It's
Yep.
the survey. And so is there a difference between me sitting down and kind of going through that survey with them and helping guide them through it where I don't actually send it to them? Is there any liability on that? Should I always send the survey as opposed to sitting down and going over it? It's almost like they're signing off on what they're doing, or like what does that look like?
That's really a good question because I hear that question probably more often than you would think. And what I'll say is it's preference. So
Mhm.
some advisors like to just fire off the email link and let their client go through it and then have a conversation with them and say, hey, look, let's talk a little bit about some of your responses on here. Did you really look at the job description for chief
Right.
executive? There's two people in your company. There's multiple layers of management involved in being a CEO. I
Right.
don't think you have multiple layers of management, and your reasonable comp is very, very high. If we make this adjustment, let's look at the description, make sure it makes sense to you. Oh, look, we've just dropped your reasonable comp by $20,000. I've now just saved you X dollars in payroll taxes, and really showing that value.
Right.
So
Yeah.
that's one way. Another way is just to sit down and say, well, let's kind of go through this. And as you're going through this, talking with them about some of the different hats that they're wearing, and different advisors have different styles, but depending on where you fit into their world, you may be able to help them realize that some of these duties aren't ones they either are particularly good at or wasting their time on. Just
Hmm.
get out there and get you making money.
And I love that piece and that little nugget right there alone. I know for myself, I use time tracking tool. Of course, we used to use T-Sheets, which was always like my favorite company ever. But tracking that time, I realized in 2000, I believe it was 2017, the fall of 17, where I had looked at my, you know, what am I doing on client work versus admin work? And I was at 60-40, 60% administrative, 40% actual getting work done. And I'm the highest billing person in the company. So I knew, because of that evaluation, that analysis, if you will, I needed to hire an admin. I had no admin. It was me and 10 employees, and I had no administrative person. I was it. And I'm like, you're an idiot and you're advising other people. So let's just put that out there. I get it. And so I hired somebody, and that totally changed the financial future of my business, because I was allowing someone else to kind of take control over that. So being able to have that conversation and having them, oh yeah, you know what, I am mopping the floor. Why am I mopping the floor? I can bring somebody else in here to do that, or whatever it may be. That's an example.
Right.
And so I think that that's another important conversation to have with your clients. So if you're looking, I don't know how to get into advisory. We've just given you like 7 things to do that you can put on your little checklist of, these are the things I'm going to do as part of my advisory work. And so,
Absolutely. And we're talking about just how they're spending their time. We haven't even talked about their retirement or their exit strategy,
mhm,
right? Most people worry about the compliance piece, which they do need to worry about. Don't get me
sure.
wrong, that is important. Uh, but the smiling, right?
Mhm,
The client smiling, going, oh my gosh, I hadn't thought about getting my retirement to where I need to get.
yeah.
Or I do want to exit the business. Let's put that plan together and let's get reasonable comp figured out so that when we get an offer and they're normalizing those books, that we get the valuation that we want.
I think, and that's such a super important point, because as people are looking to sell their business, we've had clients contact us about they're ready to sell their business, and we go through a process. I usually just outsource it. I don't necessarily get heavy deep in that, but if I can at least do some groundwork to balance that reasonable comp and be able to make that work, that piece of it work for them, and the buyer is going to be so much more attractive. The buyer will be more attractive to the business to buy it if there's facts. So clients say, I'm looking to buy this company. Here's a copy of a tax return. And I look at it, it says self-prepared. It's the first thing I say, hey, listen, this return says self-prepared. I don't know if it was actually ever filed. Like, this could be just a made up return. So those kind of little things. Same thing with reasonable. If you're looking at an S corp, you're buying an S corp, or you're buying a partnership. If you're looking even at an S corp, you're saying, what was the officer's salary on that line? And then you look at, oh, well, it's a partnership. So, well, what were the guaranteed payments? Are these people even paying themselves? And it's like, well, we know they don't want to pay themselves too much because they don't want to pay taxes. And definitely partnerships, they don't want to pay self-employment tax. They certainly don't want to take guaranteed payments. So those are just some hints to a buyer when there may be some irregularities or something that's wrong. But when you can say, listen, this officer's compensation was based on calculations on what they did. And guess what? Here are the things that this business owner did. You may not want to do the same things as this business owner. You may say, you know what? I don't want to schedule calls. I would never do that. Okay, great. Now you know you need to hire somebody. But now you're seeing what those owners were doing, not just what they were getting paid. What a value you add to that business.
Absolutely. And if you've ever had a client come to you say, Don, I think I'm about buying this business, we look at the books
Yeah,
and it's like, hey, Paul, this person's only paying themselves $24,000 a year. They should be paying themselves about 100 and a quarter,
right.
right? That's a $100,000 difference, and you're looking at a 10 multiplier. we're going to knock about $1 million off your buy.
Exactly. So those are just some of the things. And I think obviously this is a podcast. We're at least, getting some information out there, but there's so much more that people can go to rcreports.com, and there'll be a link in the podcast. You'll be able to have a link right to their education platform, the on-demand webinars that they can watch at any time. And just to get yourself more familiar with this super important concept, or actually it's a requirement, a compliance related matter that we need to be paying attention to. And thankfully, Paul and his team at RC Reports are giving us tools that we can just go and use and not have to use the Google, which isn't going to give you bulletproof reports anyway. But and to think of it more, I think my message to people is to think of it more than just reasonable compensation, which at $5,000 a client, I don't want to take those chances. But it's more than that. It's a tool you can use in your advisory role with your clients to say, hey, listen, let's take a look at what you're paying your manager for this restaurant. And, is it what's the range out there for your location and those kind of things. There's so much more that we can do with this tool. And it's one place with many tools, essentially, that we should be thinking about. Any last thoughts, Paul?
The only last thought I'll share with you, because when we started this, and it's kind of a full circle conversation of how we went from, having this be my own problem to helping it create RC Reports, is this. For the do-it-yourselfers out there, I get that. That's how I started out. It's a 2-day process. This is now a 5 to 15-minute process. It'll save you a tremendous amount of time if you need to figure this number out. And so from that perspective, I think that's where I come from. I love the fact that it's used for all these other reasons and all these other things, but time is the only thing we don't get any more of ever.
Absolutely. I think there's always the ability to make money, but to make time is really tough. So with that, thank you, Paul, so much. Paul with RC Reports. This has been an amazing discovery, is what I would say, for my practice, and what I'm able to do for my clients is so important to me to help them in whatever way I can. And this is just an easy, by the way, super affordable tool, which I don't want to say that, Paul, because I don't want you to increase prices, but I can say with confidence that I was like, this is like a godsend for me and my firm and my clients. So I thank you for having pain points that caused you to move in the direction of giving us this tool that is going to be so helpful for all of us. But thank you again for coming on the DM Disruption. We'll talk to you next time in our next episode. Very excited for those of you who are listening, and I hope you're getting so much knowledge out of this and education. So with that, Paul, thank you again so much, and we'll see you.
Thanks for having me on, Don.
Absolutely. We'll see everybody next time. Thanks again.